We think women need to talk more openly about money because money really matters. It shouldn't be embarrassing or confusing. Join the conversation. We'll be discussing a whole range of topics which will help you get comfortable with your finances. Money Matters, brought to you by AJ Bell.
Hello and welcome to the AJ Bell Money Matters podcast. I'm Danni, and of course I'm joined by Laura to talk through the money news that matters to you.
Hello everyone, and I'm sure most of you know the drill by now if you are regular listeners, or maybe you're a relative newbie. Maybe you're listening for the first time, or you found us recently because you're a fan of our recent guests, Eileen Phillips or Julia Gillard.
Yes, so if you are a newbie, the idea is Laura and I chat through the one big thing that's likely to make a difference to your finances right now before we bring on our special guest, either to talk about their story or to give us some insight into a particular money issue.
So this week we're going to focus on student finances, and we've got the brilliant Laura Brown from Save the Student to take us through all of the money issues that matter to those students who've just finished their A-levels and are hoping to start university in the autumn, or those in their first year of their A-level courses who are going around the different universities this summer, and also those parents who I'm sure are excited for their kids' next stage, but might be starting to realise just how much it's going to cost over the next 3 or 4 years when their kids go to uni.
That is me, Laura. That is exactly where I am at the moment. So we've penciled in a bunch of tours to different universities, which themselves are costing a blooming fortune. But then you start thinking about how much accommodation's going to cost and all those extra bits that they probably aren't going to get a loan to cover. And you realise quite how much pressure is going to be put on parents. I've just written an article about this, which you'll be able to find on the Money Matters website, along with all of our other articles as well. So that is ajbellmoneymatters.co.uk.
And of course, you can find all of our podcasts on there, and you can sign up to our newsletter to become part of the Money Matters community. Just go to that website, ajbellmoneymatters.co.uk, and click join our community. We'd also love to hear from you on social media. We're on Facebook, Instagram, X, and we can keep you up to date there with all of the latest podcast articles and events that we're involved in as well.
And we know that the big thing that is concerning lots of you at the moment, because you've been in touch about this, or Laura and I speak on television and radio all the time, and it's something that is constantly coming up, and that is inflation and the 2% target, which we have just reached. Literally a couple of days ago, the UK got back to 2%. But why then did the Bank of England not cut interest rates?
And that is the question that everyone is asking. So we thought we'd go back to basics and just talk about that link between inflation and interest rates, and why the Bank of England hasn't made that move. And then we're going to do we'll get our crystal ball out, Danni, and do some little bit of forecasting into the future of when we might actually see that interest rate cut. So Danni, should we just start off with a very quick explainer of what inflation is for anyone who's not quite aware?
Yeah, absolutely. Before we get the crystal ball out and live dangerously, let's talk about inflation. So in a nutshell, what it is the general increase in the price of goods and services. Now, there are a few measurements, but we tend to use what's called the Consumer Prices Index, or CPI. And the Office for National Statistics measures that every month to see how prices have changed compared to the same time last month and the same time last year. They use a basket of goods, they compare 700 different items, and they look at over 120,000 different outlets, and then they work out the average change. And that basket of goods is changed every year because it needs to reflect what we're buying. So, for example, during the pandemic, hand gel went into the basket. A few months ago, it came out again, but in popped air fryers, gluten-free bread, and vinyl records. Now, I'm not going to go into the difference between CPI, CPIH, RPI, because that just adds an extra layer of complication. And when we're talking about the cost of living crisis, when you've seen all those headlines over the past couple of years, that would have been using the CPI figure. So let's assess where we are now. 2%, we were just saying. We've got back to 2%, which is the Bank of England's target. Lots of people saying we're back to normal, hooray! And it is certainly an awful lot more palatable than the peak that we saw back in October 2022, when inflation in the UK hit a 41-year high of 11.1%. Now, the reason for the big spike in inflation was primarily the war in Ukraine, which sent oil and gas prices spiraling. And think about how much energy is used in making stuff, transporting stuff, and just keeping the lights on in the shops where you are buying stuff. So it wasn't just the price of our gas and electricity in our homes that went hurtling up. Food was a huge issue for a lot of people. And I was just looking, May last year, food inflation hit almost 20%. Now that has slowed. We've seen energy prices come down. The price cap, of course, is lower, due to fall again in July. And we're not getting that gulp moment at the checkout anymore. You know, when you see how much things have cost and compare them with where they were just a week ago, inflation might have come down. But crucially, Laura, it doesn't mean that prices have come down. It's just that they're not going up quite as fast as they were. And as of May, which of course is the last figure that we have that CPI data for, it was at 2%.
Now, you also might be asking, why is 2% the holy grail? Why is that better than 1% or 0% or 10%? I mean, I think we've all experienced why 10% inflation is not a good thing, but effectively the Bank of England sets 2% as its target because that's the kind of ideal level that it wants prices to rise by. So you don't want prices rising by too much, as we've all experienced, because then you have these huge increases in the cost of things. People's wages struggle to keep up with that, but also people will be putting off purchases because their money just doesn't stretch as far. Equally, you want prices to keep rising because if prices were falling, for example, something that's called deflation, another lovely jargony word, but if prices are falling, then people will delay buying things because they'll think, okay, well, I could buy this item for £100 today, but because prices are falling, it might be £90 next month or £80 the month after. And you need people to be out there spending their money to stimulate the economy and for it to continue growing, businesses to continue growing, which obviously then feeds in to the UK's overall growth and also things like our wages being able to go up because companies are doing well. So 2% is kind of the target that the Bank of England has set it at. I don't think it's ever said we will consistently hit this every single month, but over the kind of medium to long term, that's the level that it's aiming to hit. And it would be quite the precise job to hit that every single month. What the bank has now said is, you know, it's 2% now, and that is obviously great that it's returned to target. And I'm sure they're giving themselves a big pat on the back for all of the work that they've done to reduce inflation. But they are expecting it to rise again before the end of the year. So there's a few things that will kind of filter through into the figures that will mean that it jumps slightly from that 2% target. Now, emphasis on the word slightly there. People don't need to panic that we're going to suddenly shoot back up to 11% inflation. What they're expecting more is it kind of hits 2.5% effectively. And the bank will want to have some confidence that inflation is going to stay around that 2% level over the medium to long term before it cuts interest rates. Now, I think probably we need to cover why interest rates matter for inflation. So the Bank of England uses interest rates as one of the ways to control inflation. By raising interest rates, that makes things like our mortgages more expensive, as we've all experienced, and other debt more expensive. And so it means that generally people have less money out there to spend. If people are spending less money in the economy, then that tends to have the effect of pulling prices down, which drops inflation. There's a very kind of basic level of explaining the two together. And so once inflation has hit that level that the Bank of England wants to see, it might then deem that it could cut interest rates because it doesn't need them to be so high. If it keeps them high for a long period of time and inflation has already fallen, then you would see that kind of slowing spending in the economy, and you might end up with either no inflation or deflation, that term I talked about earlier, where prices actually drop rather than rise. So Danni, we recently this week had interest rate decision from the Bank of England, and they decided not to cut rates, even though we've hit that 2% level. So having just explained all of that process and how they interlink, people might still be thinking, but why didn't the Bank of England cut interest rates?
Yeah, I heard a lot of people asking that question on the different news outlets, and also a lot of people on social media, because, ever since the Bank of England started to raise interest rates from that ultra low level of 0.1%, which is where they'd been since March 2020, and crucially, they'd not been above 1% since 2009. So people have got used to having really low interest rates. Their mortgages, they found them affordable because they've been on ultra low rates, and they just haven't been used to this. But since December 2021, when we saw things start to creep up from 0.1% to where we are now with a base rate of 5.25%, the bank has been saying we need to keep monetary policy sufficiently tight to help bring inflation down to that 2% target. And you just explained how they use that to keep down to that 2% target. So most economists, analysts, and investors didn't expect a change, and I'll explain why. So we got to the 2% target, but it's just 1 month. And there are a couple of factors, as you say, which suggest inflation might go up again. And again, I've got to stress, not by as much as we saw before. We're talking about maybe 0.5%. But the big thing that the Bank of England was talking about when they made their decision was something called core inflation. Now, as the name suggests, that is at the core of the economy. It strips out the volatile things, the things which have been making inflation jump up, food and fuel, and then it examines what's on the inside. So how those price shocks have been absorbed and what's happening at the heart of the economy. And whilst goods inflation, stuff, is actually in negative numbers, the price of overall stuff has been falling, the service inflation is still high, way above 2%, almost 6%. And when we're talking about services, we mean, haircuts, holidays, broadband, insurance, and some of those things, they only change price once a year. And that's why this is a big worry, especially because lots of those businesses are still putting up their prices because they're still feeling increased pressure from things like the increase in the national living wage, which means that the cost of paying their staff has gone up. But there are a couple of other things to consider too. Petrol prices have ticked up, the extra cash in people's pockets from those wage increases. Wage growth was still at 6% in the 3 months between February and April. Now, I know if you factor in inflation, we're only talking 2.9%, but it does still mean people have a bit more money in their pocket. And then there's a little thing called the general election. Now, the Bank of England isn't political. It's been really keen to stress that it is independent, but still, cutting interest rates before the vote next month could have been seen as favouring the current government. So with the economic data showing that some caution was needed, I think they were going to grab that, whatever. And of course, you've also got to factor in that whoever forms the next government will have economic plans, and they could change the story, Laura.
Exactly. And I think, when the Bank of England releases its decision about whether it's raised or maintained or cut interest rates, it also has some kind of commentary and wording around it. And I think what everyone took from the latest wording where they said we're going to maintain interest rates, everyone took, but they appear to be much keener to cut interest rates soon. Now, there's not a meeting of the Bank of England in July. The next one is in August. And so now everyone's saying, well, all eyes are on August for the first cut to interest rates, which markets are pricing in, a chance of it happening, but it's certainly not a foregone conclusion. And I think the only thing that I would caution is that if we get a new government in the general election, they are then likely, whichever party comes in, they are then likely to have an economic update, a budget of sorts. And that could be as soon as kind of September, it may be October, it depends on the party that comes in. And the Bank of England is going to want to factor in what the economic plans of the government are into its rate cutting. Now, that doesn't necessarily mean it's going to hold off on a rate cut on August. It could do that one initial small cut in August and then, wait to see the economic plans. But it's certainly a factor, because if a government started handing out tax breaks to everyone and putting a lot of more money in people's back pockets, that means they would go out and spend that money, and that potentially causes a spike in inflation. So the Bank of England really has to factor in what the government is doing with both personal taxes but also government spending into how the economy looks. And I think one other thing to just point out is that we're not expecting, the Bank of England to take a huge axe to interest rates and start slashing them by large amounts when it does cut interest rates. We're expecting that first cut to be 1/4 of a percentage point, so to go from 5.25% at the moment down to 5%, and for the cuts to kind of be incremental and spaced out rather than coming as thick and fast as the interest rate rises did when we saw rates go up. So while every little cut helps when it filters through to kind of mortgage rates and people are remortgaging, I don't think people should certainly expect that we're going to go from 5.25% that we are at the moment all the way down to kind of 4 or 3% in any kind of short time period.
And I think people are just going to have to get used to having higher rates. I mean, the period that we've just lived through has been extraordinary. We had the financial crash, we had the pandemic, all things which impacted the Bank of England's decision-making process. They were trying to keep the economy going, which is why we've had ultra low rates for so long. But before that, that just wasn't the case. And I know I've heard a lot of people talking about, in my day, we were used to having rates of 6, 7, 8%. But of course, house prices have gone up by so much. And that means that a lot of people now have extraordinarily high mortgages, taking a huge chunk of their household income. And that means that when you get these price shocks, it is tricky. And I think I saw a figure of 160,000 households coming off fixed rate mortgages every month at the moment. And they are going to be going on to higher mortgage payments. It is going to be hard for a lot of people. So do make sure that you talk to a broker, you talk to your bank if you're having difficulties. And also, I think it's really important that when we're talking about inflation back to 2%, we're not saying prices are back to normal. They're not back to where they were before we had this shock. I mean, I saw the ONS was putting out that food prices are 25% higher than they were, and overall goods 20% higher. So even as our pay packets start to gradually get sort of slightly bigger, we're only talking about small amounts compared to those price shocks that we've now had to price into our household budgets.
And I think also when we talk about interest rates, we focus a lot on mortgages, but actually that has a knock-on impact on people that are renting, because if the landlord's mortgage costs have gone up, they're going to pass that on to renters. And we've seen huge increases in rental costs, which affects all of those people that aren't yet on the property ladder, but it also particularly affects students, doesn't it?
It really does, particularly because things like maintenance loans and grants haven't gone up by as much as inflation over the past couple of years. So it means that many parents, and I now count myself amongst them, who are having their own struggles, are now having to try to find some extra cash to cover the shortfall.
It's also prompted lots of students to consider whether a degree is actually for them, whether taking on all of the debt for tuition fees and maintenance loans is really the best choice, or whether maybe they should look at other options like going straight into work or going to an apprenticeship. I've been crunching the numbers for those who have got student debt, and I'll talk through a bit later when it's right to try and rush to pay off that student debt and when it's better to just stick with it for the duration. I'll talk about that after we hear from Laura Brown, who is head of editorial at the website Save the Student, which gives free, impartial advice to students to help their money go further.
Laura, thank you so much for joining us. Look, it is an incredibly scary thought going to university. And let's start with the students who've just finished their A-levels. They've now got that awful long wait to find out if they've got the results that they need. Do you remember that time?
Oh, vividly. Yeah, that was so. I just remember like the whole build up to it, just each day. I think it was like all I was thinking about basically for the whole summer holidays. Is just reach have time.
Well, I must confess that I got my results when I was on a Club 1830 holiday in Spain, and I didn't get the results that I needed. And I actually resat a year of A levels, but I was an August birthday, so didn't really miss a lot of time. But just for
Mm.
anyone listening out there who maybe is thinking that they've not done as well as they needed to or wanted to, don't worry, take a breath. But
Yeah.
assuming that they have got the grades that they need to get to one of their choices, they should have already had their hands held through the application process. They should have applied for their student loans to cover tuition costs, maintenance loans to help with things like accommodation and other costs. But what advice can you give them to make sure that whatever they have in the kitty when they start in September is going to stretch until they get that next bit of cash?
Yeah, so the first thing I would suggest is taking the time before starting to do a bit of research and to essentially be aware that unfortunately for a lot of students, the maintenance loan by itself isn't enough to cover living costs. For example, in our most recent National Student Money Survey, we found that for the average student in the survey, the loan was only really covering around 46% of their living costs. So that is a lot of money that students are needing to find from elsewhere to make sure they have got enough to get by. So one thing I would suggest at this point is, if possible, perhaps think about things like a summer job, trying to spend the time now earning a bit of money, having a bit saved up, just so that when starting university, there's just a bit more in the account that it will make a massive difference. I think like anything a student's able to save, or it really will help. And it also takes away some of the pressure then when at university, for example, if they're not sure if they've got enough time for a part-time job while studying, if they can spend the time now, that will really help. And also think about things like the student bank account, doing a bit of research to compare the offers and making sure that they find the best one for them. For example, it's usually around A-level results day leading up to Freshers Week that the banks will start announcing like the sign-up incentives, and that's usually when you can find the best deals. So it's really definitely worth spending a bit of time to compare the offers. And for example, we have a guide on our website that compares the top student bank accounts, and we'll sort of go through things like the sign-up incentives and also things like the overdrafts, thinking about if a student, not all students want to use an overdraft, which is obviously understandable, but just being aware of it as an option, because it is a feature of student bank accounts that you can get fee and interest-free overdrafts, often up to around like 2 or 3 thousand as a maximum. And it's really just sort of being aware of it as an option that, for example, if you're reaching the end of term, knowing you can dip into that money and not be charged for it. Sort of just doing the research and making sure you are getting the best option for you can really help.
Is it worth having two accounts? So you've got one where the majority of your loan is and one that you sort of top up every month so that you know that that's how much you've got to spend for that month, and you divided it among the months that you need to cover with that pot of cash?
Yeah, this is a really effective budgeting tool, actually. For example, getting an app-based bank account as a secondary account, particularly one with good budgeting features. So, like you're saying, if you've budgeted and you sort of know how much you can afford to spend any given week or month, moving that money across and then only spending that money, sort of quite quickly, it's much easier to see how much you've got left of your budget and stay on top of it.
Because I would imagine, the first time you go out on your own, you don't realize how much it costs to do the weekly shop, or, to
Yeah.
cover getting your clothes washed and things like that. It's quite an eye opener.
Yeah, it really is. We often hear about things like the cost of cheese. Like it's such an expensive item that a lot of people really underestimate. And it's only when you sort of like you're buying it for yourself that you realize that, oh, it's actually really expensive. So things like that, yeah, it's quite hard to sort of fully prepare until you start spending the money, you start buying things for yourself, and then you realize that, yeah, like you're saying, a lot of things are a lot more expensive than you might expect.
And I would imagine the last couple of years, I mean, everybody has been impacted by cost of living going up and up. And although inflation's now back down to 2%, prices are still 20% higher on average than when they were 3 years ago. So I would imagine that for a lot of students, that's created quite a lot of hardship.
Yeah, it definitely has. And an issue we've seen, particularly for students from England, the maintenance loans haven't really been keeping up with inflation over recent years. And so although they have been increasing by small amounts, it's not really enough in terms of like the real terms value to make sure that they have got enough to get by. So it has been increasingly difficult for a lot of students, and it's harder than ever really to make the money stretch. So hopefully with the reduction in inflation, it will get a bit easier, but it's something to be aware of that it's not easy, and prices are high, and fortunately the maintenance loan often isn't enough to by itself to cover it.
So you were talking about getting a summer job to try and sort of create a pot of cash before you start university, but I would imagine lots of students also have part-time work alongside their studies.
Yeah, it's pretty common. I mentioned the National Student Money Survey, and in the most recent survey, 56% said they had a part-time job. So just over half. So not necessarily like the vast majority, but a lot of students do have a part-time job. It can often come down to, for example, like the course intensity can impact whether a student feels able to have a part-time job. If they've got a lot of contact hours, it can make it quite difficult. So for those who feel able to, it can help. I'd also say for those who perhaps feel like they can't fit in regular shift work, like at a bar, something like that, they could think about more flexible ways to make money, like private tutoring is quite a good option for a lot of students. They can set their own hours and they sort of choose when they're working. And for example, like then when it comes to like essay deadlines, it's just a bit easier that they can sort of like decide when they're working and still earning a bit, but without the pressure of feeling like, oh, I can't make this shift for any reason due to university.
Let's fast forward now 4 or 5 years. Assume that they've done their degree, they've come away with a first or a 2-1, fantastic. But they've then got a huge wad of debt hanging over their head. If they've not already looked into this, and I'm sure most students have taken a look and know exactly how much they're going to have to pay off, but when do they start paying that off?
So you start repaying the April after you finish your course, and only then when you're earning above the repayment threshold. So the repayment threshold vary depending on which repayment plan you're on, and this is impacted by whereabouts in the UK you're from and when you start university. So it's worth being aware which plan you're on so that you can prepare for those repayments, and then you'll be repaying 9% of what you earn over the threshold. And a benefit of the system is that because it's linked to your salary, it does make it more manageable. And if your earnings go below the repayment threshold, the repayments will stop until you're then earning above it again. So in that way, it's aimed to be affordable. And so although it can seem quite daunting, the idea of every month making these repayments, the fact that it is linked to your salary does help.
Psychologically, it must be quite an impact for young people. I know that it doesn't impact your credit score. It's not the same as credit card debt or anything like that. But do they worry about debt, students?
Yeah, I think it's inevitable, I suppose, when you see the student loan statement and there are big numbers on there. It's quite daunting, and particularly when interest is high, it's a lot of money that's being added, sometimes more than you're repaying. And so it is difficult in that respect. But I would emphasize that, like I was saying, in terms of the way that the repayments are calculated, it is aimed to be affordable and manageable. And it's also worth knowing that the debt will be written off after a certain amount of time. Again, this varies depending on which plan you're on, but it will vary between 25 and 40 years. So even if you haven't repaid in full at that point, the debt will be cleared. So that is something to uh, a positive of the system, but I do also understand that it can be really concerning to see how much you've got left to repay.
So you shouldn't worry if you're looking 40 years ahead and thinking, there's no way that I'm ever going to get rid of all these zeros off my student debt.
Yeah, that it is useful to know at some point the debt will be cleared, even if you haven't repaid it all. That it does help in that respect.
So in some cases, I know maybe you're looking at the debt and you're thinking, right, the thing I need to do is clear it off as quickly as possible. But maybe it's better to, instead of clear off your student debt, which might be wiped out in 25, 40 years, as you say, maybe it's better to start thinking about other things like saving for a house deposit.
Yeah, it could be. I think this could vary depending on the graduate's situation, because for the higher earning graduates who are likely to repay it in full before the debt is cleared, they might sort of decide it is worth repaying it early to avoid that added interest from that by paying early. But then for those who aren't on track to repay it all in full when the debt is cleared, they might actually end up spending more money by paying it early than they would have done otherwise if the debt had been cleared at that point. So it could be something, it might also be a case of like deciding what your priorities are in terms of your financial goals. If you decide that you do want to save up for a house first, then you might just decide, I'll keep making the standard repayments for the loan, and then any extra money you save, you could put towards the house deposit. I would say for someone in that situation of making that decision, probably worth speaking to a financial advisor and making sure that you are making the right decision based on your finance and your individual circumstances.
Is it worth it getting a degree now? Because you read so much, you talk to students who say, I'm not going to go to university. I don't think it's worth it. And I know that there are more options now, a growing number of degree apprenticeships. Are they becoming more popular?
Yeah, I think degree apprenticeships are really brilliant schemes. I think the opportunity to keep studying while also gaining that workplace experience and earning a salary is a really great opportunity. And I could see for a lot of people leaving school that that could be a really great option for them. There's a lot of debate around whether you have the value of degrees. And what I would say is that they can be great for a lot of people, but they're not for everybody. And I don't think people should feel pressured to go to university just because they think that's the expectation. It's not always the best option. And like you mentioned, degree apprenticeships, but you could also consider perhaps going into an entry level role, or perhaps like traveling and working abroad, or even like starting a business. All these different options could be the right thing for different people. And it's really just a case of making sure that young people are aware of all the options. And if they decide to go to university, great. But then if not, knowing that they have all these other great options that could actually be so much better suited to them.
So let's talk about those students who are now thinking about starting the process. And I have to say that I have an ulterior motive for speaking to you, because my daughter is about to start this process. We've just sort of booked a few open days to go and have a look at some universities. What is the process of applying for tuition fees, maintenance loans, that kind of thing? And how much are we talking about?
So it is quite a straightforward process. There are quite a lot of forms to fill out. The first thing you need to do is find out which student finance organisation you'll be applying through. So it varies depending on where in the UK you're from. So there's Student Finance England for students from England, Student Finance Wales, Student Finance Northern Ireland, and then there's the Student Awards Agency Scotland. So this is based on where you're from rather than where you're studying. So, for example, a student from England but studying in Scotland will apply through Student Finance England. So you can apply online, but the amount you get is firstly dependent on which organisation you're applying through. They have different systems, and this can affect how much you receive. Also, whether you're getting money just as a maintenance loan, or some systems have maintenance loans and maintenance grants. But then the amount that you can receive will also vary a lot depending on both where your living situations while at university. So, for example, students who are staying in their parental home will get a lower maintenance loan, whereas those living away from home will get slightly more. And then those in London usually get more as well. And then the next factor is household income, which generally affects how much students will receive. So for those with higher household incomes, they'll usually receive a lower maintenance loan than those with low household income. Sort of with the underlying assumption that those with higher household incomes will have more money, could be perhaps from parents, which is an issue with the system because obviously it's not always reflective of how much a student actually will receive.
So I'm guessing that parents like me are going to have to stump up quite a chunk of cash to cover the shortfall between what they get in the maintenance loan and, how much it costs for accommodation and, living.
Yeah, often. It is an issue that, like I was saying, with the way that it's structured, because it's not always reflective of how much students are actually receiving from parents. So I would suggest it's worth looking into how much the student is receiving as a maintenance loan and then comparing that to the maximum available. And then that difference is kind of how much they're missing out on. And you could use that as a guideline for how much money to give them. But then we do hear from students who don't necessarily receive the amount of money from their parents that they're missing out on through that loan. So it is an issue, and it's affecting students in terms of they're not necessarily always receiving that shortfall.
It's certainly been an eye-opener for me, just looking at accommodation costs and just thinking about how much I'm going to have to fork out. And you pay termly, I believe, so you've got to pay up front and find that cash as a parent or a student to cover your accommodation cost at the start of every term.
Yeah, it's definitely the biggest expense for most students, apart from those who are living at home. Rent does take up a huge amount of their living costs. Sometimes we even hear from students whose rent is more than their maintenance loan. So it is extremely difficult. One thing to be aware of is that with university halls in particular, it's quite common for bills to be included within the rent. So this is one area that could be saved. So although rent is still a lot of money, it is worth knowing that you don't then need to be thinking about energy bills on top of that. And full-time students as well are exempt from paying council tax. So that's another area in which they can save. But no, you are right that rent is very expensive.
Now, we're coming up to an election now, and what's been really interesting is hearing from young people, students as well, saying that they don't feel any of the political parties are talking to them at the moment. If you could ask them to do anything to help students, what would it be?
The number one thing would be ensuring that students have more money while at university to cover their living costs. The ideal would be as maintenance grants, so getting that extra money without the added pressure of then having to repay it later on. But if not maintenance grants, at the very least, I'd want to see an increase in maintenance loans. As I mentioned earlier, with loans having not kept up with inflation over recent years, it's even harder than it was already, and it was already difficult. It's got even harder, and we do hear from students who are really struggling to afford daily essentials like food and rent and bills. And so I see the most urgent issues is making sure that students while at university are receiving the money they need.
And I know there's been a lot of talk about the fact that in Scotland, students get their tuition fees paid for. There's no sign at all of that ever happening again, England, Wales, Northern Ireland.
Yeah, it's a difficult issue because it affects both universities and students. While at university, it doesn't necessarily impact students directly if they can get the tuition fee loan. But obviously, it then does have that impact afterwards of adding significantly to the graduate debt. It's a lot of money to be repaying. So if we were able to see removal or at least a reduction of tuition fees, that would help students in that respect. But then I suppose on the other side of that, there's also the issue for universities then that they're relying on this money, and it's sort of like weighing at both sides. Like I would like to see government finding a way for both universities and students to make sure that it's manageable on both sides, and that universities have enough money and students don't have that burden of tens of thousands of pounds to repay.
Look, Laura, it's been great to talk to you. Thank you so much for your time.
Thank you. Thank you so much for having me on.
Laura Brown from the website Save the Student, and you can access the website at www.savethestudent.org, or you can find them on social media. Now, before we hear Laura Brown's financial confession, too many Lauras, Laura Brown spoke about when paying off your student loan quickly is the right move and when it might not be, a little bit, but you've been crunching the numbers, Laura.
Yeah, I have. And I think I'm going to caveat all of this with basically it's nigh on impossible to work out whether you're better off paying off your loan, either whether you're doing that in chunks of money or entirely if you happen to be, handed a pot of money equal to your loan. It's so tricky to work it out. It basically depends on your future earnings potential. So not just your starting salary, but how much your salary rises throughout your career, but also whether you take any career breaks, whether you do any part-time working. I mean, for women particularly, this is a consideration. If they end up having a number of years out of the workforce because they have children, or even if you want to go on a gap year at some point and take some time out, or if you return to work part-time, that obviously has an impact on your salary and therefore an impact on the amount of loan that you would pay off and whether it's worth paying it off. So there's so many factors that it's quite tricky to work out. And I think if we take the example of someone who, this is, I acknowledge, a not very realistic example, but someone who graduates university and gets handed, let's say, an inheritance that's equal to the amount of loan that they've got. And they have this dilemma of, do I pay off my loan so that I don't have that hanging over me for the next 30 or now even 40 years based on the new loan system? Or do I use that money elsewhere? They need to factor in all of those things that I've talked about, whether they would actually pay off the loan in that time period ordinarily if they left that money, or whether their earnings just wouldn't be enough that they would pay off all of that loan. But they also have to factor in the flip side, which is what else you could do with that money. And so you might decide, okay, I've been given a chunk of money and I would rather use that to get on the property ladder, or I would rather use that to buy my next home, or to take a career break and go traveling, all manner of things that you could use that money for. Because once you've paid off that amount of your loan, whether that's a chunk of money of the loan or the entire loan, you can't get that money back. And so people really need to weigh up those options. It's not dissimilar to when we talk about, whether people should overpay their mortgage or not. It's that whole thing of it's a tricky dilemma. Some of it comes down to personal preference. Some people may find that having that student loan repayment hanging over them for the next 30 or 40 years and chipping that bit out of their salary each month is actually just psychologically not something that they want. They don't want that additional tax. And so then for them personally, even if maybe financially they're not 100% sure it makes sense, for them personally, it might be better to pay off that loan and get rid of that debt. So I did run a few numbers to try and give people a kind of example of when it's worth paying off. So I've done it for the Plan 5 loan. So for those who aren't down with student loan jargon quite yet, this is the latest loan that you would go on if you were going to university today, basically, if you were starting university this year. And so if you have a starting salary of £20,000 and then we assume that your salary increases by 3% a year, this regular amount all throughout your career, and you take no career breaks, no part-time working, and you don't take early retirement, so you just carry on working throughout your career. So your total loan payments in that example would be just £235 across your entire career. And that's because your salary wouldn't rise enough. And so each year the student loan threshold would rise, at which point you repay it. Effectively, you're not really ever going to pay off any of that student loan. I mean, you pay off £200 of it. And so then after 40 years, because debt has been added to that student loan, this is based on you graduating with £50,000 worth of debt, by the way. So the debt that's wiped out after 40 years is £167,000. But effectively, whilst that's an eye-watering amount of money to think, I've got £167,000 worth of debt, actually, it doesn't trouble you because your salary doesn't ever really rise enough to make any meaningful repayments over the threshold. But of course, I've modelled that based on someone getting a regular 3% increase to their salary every year. Realistically, that's not how people's careers work. People might see lower increases than that, and then they'll move jobs and they'll get a big jump in their salary, or they may switch into a different industry, or they may get a bonus from a job that then tips them over. And this is why it is so tricky to work out whether it's worth off repaying. If we look at something at the opposite end of the spectrum, so if you had a starting salary of £50,000, we're still assuming that same £50,000 worth of debt that you leave university with. We're assuming that your salary increases by 3% a year and that you don't have any of those kind of career breaks, part-time working, early retirement, any of that. Your total loan repayments on that £50,000 worth of debt would be almost £80,000. And so you would be paying off much more than you'd initially borrowed. You would take 28 years to repay your debt, and at which point that debt would be paid off. So in that example, if someone graduated university, a very nice person, handed them £50,000 and said you could pay off your student debt, for that individual, it would definitely make sense because they're going to be paying £80,000 for that debt in that example. However, if they took some career breaks, if they saw their salary drop at some point, if they went part-time working, all of these different things, then those figures would be different. So hopefully that gives you a kind of, some guide points, but I think, as I've made very clear, it's so tricky to work it out. And it's such a complicated system that it is so hard. And I think that's why so many people default to just thinking, well, I'll just pay it off and just see it as a graduate tax, which is how some people have kind of branded it.
It is complicated. Thank you. That's given me plenty of food for thought. And while we're talking about food, Laura B's confession was one that many of us can relate to.
One is takeaways. I find it, as soon as the suggestion of takeaways, I find it really hard to think about any other option. And I know they're not good value for money, but they're just really nice. I like the treat of a good takeaway. That's my confession.
See, I like that confession because I'm completely with you on that, particularly on a Friday night. And of course, we've got the football at the moment, and it's just like, oh, yeah.
Yeah, and then as soon as I start thinking about it, I'm just like, okay, I'm going to have a takeaway now.
And what's your favourite takeaway?
Oh, probably pizza.
Good choice.
I think it's not great value because I always know you can save so much money by getting pizza in the shop, but it's just such a treat.
That is one that I can definitely relate to at the moment. So I've recently moved house, and it appears my ability to cook and organise my food shopping has completely gone out of the window with the move. And I feel like I am on first name terms with the Deliveroo cyclist. So definitely, I think there's definitely points in your life where everything gets a bit busy and you default to this, and it's getting out of the habit afterwards, isn't it? That's always a bit tricky.
And it does get so expensive when you've got 4 in the family to feed, and particularly when they can't agree on what takeaway they want. So you've got additional charges for that. So but still, I love a takeaway, particularly pizza in a box. It's got to be done. If you want more details of some of those sums that Laura was talking about repaying your student debt, we have a load of articles on our website, www.ajbellmoneymatters.co.uk. But that is it for this episode. If you like the pod, please do rate and review it because we love to hear from you. It helps other people find it. You can, of course, tell all your friends and relatives all about us. And if you're new, do have a look back at the podcast because we've had some brilliant people on a whole range of topics, from how to get started investing to how to successfully ask for a pay rise.
And definitely get in touch with any topics that you would like us to cover, people that you think we should talk to, or just any questions that you have after an episode. If you think, oh, okay, I want to know a little bit more about that, or I've got a question about the interest rate stuff you talked about, then we're always here and willing to provide some answers where we can. So you can reach us on email. We're at hello@ajbellmoneymatters.co.uk. And we're also on social media. If you'd rather send us a message on there. We've got lots of great stuff coming up on future episodes. Our next episode is going to feature a couple of mums who started their own business because they wanted a workplace that worked around their childcare, which I think is something many of us parents could definitely relate to. But until next time, thank you very much for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.